Jeffery Cleveland is Principal Chief Economist at Payton & Regal, joining us on the phone. So, Jeff, as we look back at this session here, how good is this number? Does it raise the bar for future numbers? The unemployment rate seems to just keep surprising everybody.
Yeah, this number is great. I mean, the 3-month average, 205. The average monthly rate at 180. I mean, the narrative has totally shifted. A couple of months ago, people were like, yeah, the slowdown is here. Now that's completely gone from the data. There's not really a slowdown. Maybe versus 2018, but that 2018 at 223 per month average monthly job gain was probably an anomaly. We're kind of back to where we were in 2017. 180,000, 200,000 jobs right in there. So I think this is great, but it upsets the bearish narrative that was trying to take hold.
So, Jeff, if this is the situation, unemployment 3.5%, wage growth still steady, manufacturing okay, obviously a GM help there, but if this is happening as the global economy went through like a mini recession over the last 16 months, what happens if industrial companies and businesses here, you return to CapEx? I mean, where do we go?
Yeah, if you disaggregate the job situation, Oliver, into the goods sector versus the services sector in the U.S., the services sector has held up pretty nicely throughout this period. But you're right, it's the goods sector that took a hit along with global manufacturing slowing. And, I do think global manufacturing has bottomed out. Probably the bottom was August. We've seen 4 months of improvement, and that'll improve in 2020. So it's going to upset again the bears, but we probably have some upside risk to job growth here over the first half of next year, and upside risk to overall GDP growth as well. So that's great. And we're at 3.5 on the unemployment. I think we'll be 3.2 by the end of next year, which will be the lowest. You have to go back probably to the Korean War era to find a lower unemployment rate in the U.S. This is a fantastic story.
That's a really interesting comment right there, 3.2%, Jeff. So what needs to happen? What needs to fall in place? Inevitably, of course, we got to talk the tariff stuff here. Or do we? I mean, we're seeing PMIs start to bottom out around the world. There's been no trade deal.
Yeah, for us, the bigger story was the Fed had tightened from 2017 through 2018. That pushed up the dollar. That was the direct hit on global manufacturing. The Fed has totally pivoted now and gone the other way. So that's feeding through into easier global financial conditions. That's putting the bottom under global manufacturing. That's happening. That story is real, whether we get a trade deal or not. I think we will get a trade deal at some point. It doesn't have to happen this week or next week or even next month. It'll happen, I think, at some point in 2020. But that's not the whole story. The bigger story was the Fed pivot and the global financial conditions story that I just told you.
It's almost like, in a way, the kind of trade albatross might be working in the market's favor to keep a little bit of froth out, even as equities have gotten expensive. The fact is that there's still a lot of portfolio managers I talk with, Jeffrey, who are long duration. They're still long bonds. They've got cash or gold holdings because they think that it's not going to happen on the trade front. So even though it seems the data is lining up for a pretty clear narrative of stabilization to further growth, you could argue, hey, it almost looks too easy, but there's still a bunch of people that are betting against it.
Yeah, I think so, but I do think that pessimism is unwarranted. So, I do think the low in global bond yields, global government bond yields, is probably that July-August period, and I think investors should pay perhaps less attention to the tariff headlines. Less attention to the politics and more to the global PMI story. I think that's bottoming out and it will pick up. And, if we do have a 3.2% unemployment rate in a year's time, but we'll have more wage growth, and that'll ultimately underpin the U.S. consumer. This is all a great story. And we didn't even mention the fact that the Fed is sidelined. The Fed is focused on inflation. If we have sub 2% inflation, you have a situation now where U.S. growth has picked up. Global growth is bottoming and perhaps picking up, and the Fed is going to remain easy. I mean, this is an excellent, set of tailwinds for markets. Okay,
we've heard Jay Powell talk about how they're not going to do hikes unless there's inflation. Obviously, equities like that. Is that going to be tested if the 10-year moves too quickly? Is it going to be tested if there is strength around the world and, perhaps even a bit of a labor shortage in the U.S. has to start hiking wages, or is that so far in the future that it's not even worth worrying about?
I don't think that's a 2020 story, Oliver. Perhaps that's a 2021 story, but for the Fed to be brought back into play, I think you're talking about five-year break-even inflation, at 2.5% or higher. You're talking about core PCE, above 2.5%, approaching 3%. Now, I don't really see that scenario over the next 12 months. I think the Fed can actually comfortably remain on hold. And I mean, kudos to them. They shifted gears. They initiated, 3 rate cuts, which have eased financial conditions. And, I think that has provided a little tailwind for the global economy. So, I guess they should be commended for making the right move.
Yeah. All right. Good analysis, Jeff, to keep our thoughts going into the weekend. Really nice update here. Appreciate it on the look forward. Jeffery Cleveland, Principal Chief Economist at Payne & Regal.